In this video, traders, we're going to look at tricks that copy trading sites or copy traders use to boost their trading performance. Stay tuned. Hey traders, a very warm welcome to you. Okay, so we have a lot of different sites out there that allow you to do copy trading. We've got one that we recommend above all others. However, there are many different types of copy trading sites out there, and there are some little underhand tricks, or maybe not underhand, but a little bit of tricks that you need to be aware of when looking at these copy traders to make sure you're not following somebody that really isn't that good of a trader, but their account just looks good on the face of it. Okay, so the first one is using back-tested results. Some copy trading platforms, and by the way, should we just get out of the way what copy trading is? Copy trading is basically, if you're not familiar, you go onto a site, you see a leaderboard of traders, and you can then copy their trades. You can go on and say, hey, I want to copy this person, and it either automatically copies it in your account, your demo account, or it sends you the signals that they're doing. That's pretty much what it is. And there's a leaderboard, and you pick the ones you want, the style you want, the markets they want. Okay, we probably get that if you're watching this video. So what some copy trading sites allow you to do, not so much anymore, but they used to, is you could import back-tested results. So you could literally have 50 accounts all using different strategies, and then just import the one that was the most successful. Those results look really great. Looks like you've been going a long while, and you start to get loads of people following you, and that's how these traders make their money, because they get a chunk of the revenue from the people following them, as does the company who is providing the service. The second one, so watch out for that, guys. Make sure that look in the terms and conditions and see that, hey, can a trader actually import results, or does he have to trade live for a period of time, or a demo, or actually do the trades front test it as opposed to forward test it as opposed to back test it, so to speak, rather than importing some data. So just watch out for that one. Not so prevalent anymore, but still want to be cautious of. The second one here is withdrawing money to inflate the percentage returns. Watch out for this. Okay, let's say you have an example where someone is risking, I don't know, 2% a trade. Okay, he's risking 2% on each trade, and he happens to lose 10 trades in a row. So he's down about 20%, give or take. It's going to be slightly different if it's a strict 2% on the new balance, but you get the point. It's down 20%. But let's say he's trying to target on his upside winners. Let's say he's trying to target, I don't know, let's go 20%, right? Just for argument's sake, he's trying to target 20%. Okay, so he's losing 2%, he's trying to target 20%. Making up these numbers, but I'm simplifying it, but you're kind of going to get the point in a second. So let's say that's his risk, that's his reward. For simplified sake, he's lost 10 trades in a row, his account is down 20%, right? And that's not looking very good. However, now he makes a winning trade, and it's about to make 20%, and that would look really good, but he makes it look even better by withdrawing half of his trading account. This then is a 40% gain, technically percentage based on the account balance he's got. That then, instead of puts him in back to break even, because he has 10 losers and his one winner, normally 20%, it now puts him to a positive 20% as opposed to break even, or perhaps if the numbers were slightly different, it would be a loss. So it's skewing really the percentage, because he's withdrawing that money and it's taking the percentage based on the asset he's got. He halves it, he makes that money, he then looks as if he's got a really good kind of track record, and he can do this on and off throughout his kind of gains, especially if just before he's about to take a profit. So he's close to his profit, pulls the money out, takes the profit, that percentage gain looks far bigger than it is. You see the percentage return, you think, oh, that's really nice. But in reality, if you'd started off from the beginning, in this example, you'd be flat. But in another example, we could adjust the numbers slightly and you'd still be down. So be very careful of that one. All right, the one is curve fitting. This is really common, and I've seen some pretty brutal charts, if I'm honest, with this kind of stuff. Curve fitting really means running, multiple different strategies, and then just choosing the one that fits the market at the time. So you're fitting the conditions to the market. So you run several different strategies, and ones that don't do very well just kind of go off the leaderboard, or you can flip them to private, or you can switch them off, or whatever. Ones that are doing well are going to come up there. So let's say you're in a trending environment, you just do keep buying pullbacks, and then the other one you keep fading new highs. This one you keep doing that. You do multiple different strategies, and then you just have the best strategy that looks really really good short term. Yes, that's fine, but at some point the market shifts. You need someone who's got a real long-term record, someone who has little bits of drawdown, good boosts. You know, this kind of steady equity curve of plod, 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 plod is just not feasible. And eventually that was what will happen. I've seen guys who have traded stuff like this and they've literally been on, we'll go to this in a second, a demo account, and they've never taken a loser. They've had like a 94% win rate or something ridiculous. The equity chart looks like that, but because they're trading in a quiet environment during a quiet time, they're adding to the position, keep adding, building up massive positions that you wouldn't if you were trading a live account, and then they're closing it for a small pool. So as the market goes against them, adding, comes back a little bit because it's the type of market conditions they're in, manage to take a bit of profit, bang, get a little incremental boost in the P&L, moves up and up. But of course, the one time when the market just rips off, all those conditions change, or we get some real extreme momentum, it just wipes out the whole thing and more, because they're adding, and it's just not sustainable. It's like a martingale strategy. And go and check out a video on martingale I've done to talk more about that. So you got to watch out for that one. And that is the curve fitting, kind of fits in with demo as well. You know, demo, it's just no good following someone with a demo, because you know, they could just go crazy. They could just suddenly start, you know, taking risk that's way out of your zone if you're trading it in real money. They don't care. It's a demo. They've got nothing to lose. They've got no skin in the game whatsoever. They could just punt crazily, get some statistics that look good, and then carry on. And they've still got nothing to lose. You know, they're going to be adding to positions. They're going to be not using stop losses, because we know that not using stop losses statistically is going to give you a much better equity curve, but eventually you're going to get hammered. They don't care about that. They're just looking for that regular monthly. So watch out for that kind of thing as well. Anyone on a demo, be very cautious. Not to say you shouldn't follow someone on a demo, because you know, some people may be good and just not have the discipline to trade with real money, or not have a decent pot. That's possible. I would always recommend somebody trading a live account, even if they're trading very, very small amount, just so they've got some skin in the game. So they can't just chuck on a trade and then just go off on holiday and forget about it. And you're in the trade thinking, you've followed this guy and thinking, well, is he still managing this thing? What's going on? Is he running it? Is he kind of, you just don't know. Whereas you know, if he's trading live, he's not going to be doing that. Another one is a clone of an existing account. So if someone's doing very, very well, someone might then copy that guy's trades and create an account of that copy, if that makes sense. So if someone's doing very well, they might clone that, copy his trades, and attempt to kind of move up the ranks with that. Maybe they had a few more trades in or whatever. But at the end of the day, all you're doing is you're just paying somebody who isn't really his trades, and you should need to go to the actual guy who's doing the who's doing the good stuff, as opposed to somebody who's just copying it. Because again, that guy could just stop doing it. He doesn't care. He's just after money. He's not there to prove his trading worth. He's just there to take your money. So watch out for that clone of an existing account. So anyway, guys, watch out for your backtested results. Not so much anymore. Watch out for this little scam. You know, some account or some kind of providers won't let you do that, but be careful of that. You can see how that can be you know, seriously inflate the returns. Watch out for the curve fitting, the multiple account scam, people getting lots of accounts, different kind of trading strategies, very different trading strategies in each. The one that wins, that's the one that hits the leaderboard. Demo accounts, you know, a little bit of a caution on that one. And then anyone who's copying a decent trader already, or copying. You get the point. Anyway, guys, that's social trading, copy trading, some of the things to watch out for that some unscrupulous traders will use to boost their performance. Hope that helps. See you next one. Take care. Bye-bye.